happy new month, right? We are currently in the month of November, so welcome to a new month. A next opportunity to go at lots more goals, and I hope October had treated you guys well. And yeah, we're in November now. It's almost December time. It's almost time for Christmas, the jolly time right here. So yeah, I'm gonna try to set my phone somewhere right here for now. What's this? Sorry about that, guys, but I got a little interrupted just now with my phone. But welcome to another live stream. Welcome, guys. Let me have some water because I'm gonna be talking for a little too. Okay, good. But yes, guys, welcome. Good evening to you, Miss Cohen. It's nice to see you here. And the first one to leave a comment down below. Thank you so much. Welcome to the live. I know the orientation. Let me know if this orientation is okay for you guys, like the sideway view. Let me know if it's okay. I did it because when we're gonna go on the board, I want for you guys to be able to have the best view. So I did it like this. So let me know if it's okay for you guys with the sideway view. Hello, Peach, Jackie Rose. Good evening. Good evening to you as well, Miss Gail McKnight, Miss Johnson. That's Britannia Johnson. Nice to have you guys on the live. Good evening to everyone that's joining. Also, a quick update. I got my winter boots changed, and it's by the door. I wore it like 2 days now, but it hasn't snowed since today's Wednesday. It hasn't snowed since over the weekend, so I never wore it much. But just that's a quick update. I got my winter boots, the right size. I'm gonna try it on, but in the next video, because today I'm gonna focus on accounting for corporations. Welcome to you to let me see, Miss Gail, McLean, and wow, how do you pronounce that name? Maidia. Yeah, did I pronounce that name correct? Amedia. Oh wow, it's Amedia. As well as Miss Doreen Liller. All right, it's great to have everyone on. I hope you guys are having a blessed day. Let's give a few more persons like a minute more to get here, and then we're gonna start. So I have my already set up. So you look over here, I have my whiteboard, marker. The candle should be removed from the whiteboard, so let me take it off. And I have my tripod stick because that's where the device, my phone, is gonna go. Where did I put the question sheet though? That's a very good question, guys. I don't remember I put my question sheet. It should be somewhere around here. That's a good question. And it's not over here, is it? No, it's not these. So I'm trying to find a question sheet. It's not these that are right here. So let me check around. I'm doing great. I see someone ask what I'm doing, Miss Morris. I'm doing amazing. Thanks for asking. I'm doing great. All right. So here's the question sheets I'm going to be using today. And I post them in the community posts, right? I won't be able to unfortunately I won't be able to like have the question on the screen, but the question is in the community post. So if you want to find the question, right, you can always go by the community post and it's going to be there. All right, it's going to be by the community post. You can read it, you can scan through, and yeah, you can come here and learn one or two things. It doesn't have to be everything, but catch one or two things that if someone wants help with, or someone asks like a random question one day about pertaining to what was taught here, you can always answer, right? It's best to have some knowledge, outside knowledge. I can't even see the comments well in this section. Hello, good day to you, Peach. Who else is here? I can't even turn the phone like this. It won't allow it because of the orientation, but no worries. That's all right. So yeah, you guys can go ahead to press the like button. As you guys join. I can't really see the comments very well, but I'm seeing something. I'm seeing some of the comments. But yes, guys, go ahead to press the like button. And as I said, if you want to find the questions to what we're going to be doing today, these questions here, you can go by my community post. I made a post there earlier. Hey, Miss Campbell, it's been a while since I've seen you around. It's great to have you on the live today. It's amazing to see you here. It's been so long, Miss Campbell. It's nice to have you here today. So yeah, I'm gonna be sitting up just right over here. So let me place my camera right over here. Okay, hold on. All right, there we go. Are you guys able to see well? Can you guys see what's going on right here? You guys can see everything well, right? Let me get my chair. Oh wow, it's actually very low, right? But I'm sure you guys can see what's going on. Let me also join with you guys on my laptop so that I can see what's going on in the comment section as well. One moment, let me join from here on my laptop. Alright guys, just give me a second. Let me join on my laptop so I can see what's going on. 1 second, let me join. I can better read comments from my laptop, so that's what we're gonna do. Alright, there we go. Hello! Alright. Now I can see you guys even much better from here. Okay. Alright, sweet. Now I can see you guys. Good day to you, Miss Del Mesquita. Nice to have you here. Good evening. Let me fuck up this guy. And just to be sure, can you guys see? Let me just write something. Hello. Let's see if you guys can see what's going on right there. Ah, yeah. Yeah, you guys can see what's going on, right? Alright, sweet. Alright guys, so today, we're gonna be doing a little bit of corporations questions. The questions I said they're in the community post, so definitely go ahead and check out the community post if you wanna figure out what the questions are, because I can't have the question be held right here. You won't see well. So if you guys wanna see the questions, they're in my community post. You can scan through, read through, and then we can get started right here. So yeah, so the topic for today, what we're gonna be doing is to explain how to account for stock and split dividends and their financial impact. Right, we're gonna analyze their financial impact. We have a question right here, and we also have another question right here. We're gonna try to get through these as quick as possible, and yeah, let's hope that some persons can know a two-word thing at the end of this, right? So, where should we start? So, corporation is quite a huge chapter in accounting, right? It has many different phases. It's like so many things you can do in a corporation. But for this specific chapter, we're going to be focusing specifically on stock and dividends, as well as stock splits, as well as their financial impact. All right. Now, we have the first question. That's the question 1, right? And it's in my community post. You guys won't be able to see what this is saying, right? Because it's just too small. That's why I posted it earlier in my community post for you guys, right? Now, if you guys are reading the question, I hope you guys read the question. I do hope, because it will make it much easier to understand what's going on. So it basically gave us a shareholders equity account. That's right here. Let me use my pencil. So up here is basically the equity account for Jenny's Corporation, right? And from this information, what we have here is the preferred shares that were issued, the common shares that were issued, as well as the retained earnings. Now, I know some persons might have no clue what these are, as well as some might have clues what preferred share, common share, or retaining earnings. Some persons might have an idea of what these are, but if you're one of those persons that I said, I'm not gonna get you guys lost. I swear, I promise, I won't have you guys lost. Okay, I won't have you guys lost, as I want you guys to understand as much as I do. So the preferred shares, these shares are, they have a certain type of premium over the common shares, as they are the first one to be paid out. They are paid before common shareholders, right? So that's a privilege of the preferred shares. They are paid before common shareholders. They have some rights over the common shares, and that's one. Also, a disadvantage is that it's usually much more expensive than a common share. So that's kind of disadvantage, which makes sense. I mean, if you're gonna have some rights and privilege, of course, it's gonna come at a greater expense. So that's that for preferred shares. Common shares, just normal shares that the corporation issues to shareholders. And the more shares you have in the company, then the bigger you talk, right? The more shares you have in the company, the more you own the company, and the bigger your ownership is, right? Retained earnings, the profit that you earned right from the shares, and yeah, it's just like profit, all right? So that's the three basic explanation of these three concepts, which I hope you guys have a much more understanding. So we have preferred shares, common shares, retained earnings from the shareholders' equity. So let's answer some questions, all right? Let's answer some questions. The first one here says, assume the board of directors declares dividends totaling $1.5 million. So we have a declaration of dividends. So dividends declaration is where, you need to pay the shareholders, right? So dividends is where you need to pay shareholders, right? So whenever there has been a declaration of dividends, that means that, hey, you need to pay them some money. If you're not going to pay them some money, then you're going to have to issue them more shares. And in this context, right, that's what we're going to do, because as the name states, it's called stock dividends, right? And as I said, dividends mean that, hey, you're going to make a payout, right? But in this case, we're going to make a payout in the case of stock. So we're not using cash to pay our shareholders. In this case, we're going to use stock. We're going to issue more shares. Issue more shares, right? So just based on the fact that we're going to issue more shares, right? We're paying our shareholders in dividends, right? They're going to have more shares in the company, more ownership in the company, right? Now, a few good things about stock dividends for a business is that it makes their share on the market. It makes their share on the market more marketable. Why? So you would maybe ask, hey, why does stock dividends make the share on the market more marketable? You might ask yourself that, why? Why is the reason for it becoming more marketable on the market? Well, in accounting, if you issue more shares, the more shares you issued, so if the issuance of shares increase, that's just an increase sign. So if the issuance of share increases, then the price of the share decreases. All right, let me not get you guys confused. All I'm saying right here is that now, if you issue more shares to a shareholder, right, then the price of that share on the market decreases. When the prices of that share on the market decreases, it's going to be more affordable to those who want to purchase shares, right? So as such, on the market, your share is going to be much more in demand, right? People are going to want to buy the share. It's more affordable. So it makes sense, right? Cheaper share, okay, let me have it. It's cheaper, let me have it, So yeah. So stock dividends, you pay your shareholders in increasing the amount of shares that they owe in the company. Once you do this, then your shares as the corporation will become more marketable on the market, because it's going to be more affordable, right? So the more shares you issued, the more affordable it becomes on the market. Now, that's for stock dividends, right? You guys understand stock dividends. Can someone say something in the comments if you guys can? I don't know if you guys can see what's going on. Hold on. I don't know if I don't know. I can't see the chat. I can't see the chat any at all. Maybe it's just this account. I'm not sure. Anyhow, if by any chance you guys, okay. No, I'm seeing the chat, guys. Amazing. I'm seeing the chat now. Okay, I can't really see the chat because I don't know. This account is not signed up with my YouTube, so I can't really see what's going on right there. But let me try to switch over to my other account. Maybe that will make some more sense. Let me try to get back to the other account. Hold on, guys. I must can see the chat because I want this to be, you know, very interactive, right? Ah, there we go. Hey, let me send something in the chat. Hey guys, we good? All right, so we good, right? We good, we all good. This is just a basic concept, right? This is just a basic concept of stock dividend. It's all it's saying is this, guys, right? All it's saying. Let me even write it. Let me write it in the chat for those who probably can't, you know. So with the stock dividends, all it's saying is that we are going to pay our shareholders with shares instead of cash. That's all it's saying, guys. That is all it's saying. We are going to pay our shareholders with shares instead of cash, right? Now, due to paying them in shares, right? The market price of the share will reduce and make it more marketable on the market. That's all it's saying. That's all I explained. That's all I explained so far. So if you just came and you don't know what's going on, this is all I said just far, okay? That is all I said just far. Alright, so we're good. Alright, so let's move on. So we got that. Now, there are some effects that the stock dividend has on a few accounts. Right? So we're still talking about stock dividends, right? Stock dividends. We're talking about stock dividends same way. And there are a few effects that it has on different accounts. Right? We are saying that when it comes on the stock dividends, right, it reduces retained earnings. So it's going to reduce our profit, right, when it comes on the stock dividends, because, you know, we're issuing more shares, meaning that, hey, we're going to have to pay these people more. Right, we're going to have to pay them more, which, and you know, if we're going to have to pay them more, our cash is going to decrease. Cash involves in our profit, and if our cash is going to decrease, our profit, aka return earnings, will also decrease. However, the share capital will increase, right? Share capital will increase. It's just like this. Hey, you know, issue more share, the share capital of our shareholders is going to increase. The share capital of the corporation is going to increase, right? Because we issued more shares. All right. So that's all I just said. Right? So retained earnings decreased due to a reduction due to having to pay the shareholders, whereas the share capital is going to increase because of issuance. All right, we're good. All right. So now let's take it a bit further, right? Let's do the first question here. Let's do the first question because I know everyone wants to do the first question, right? First question. Hooray! Time for the first question. The very first question. All right, guys, ready? All right. Let's go. So the first question, letter A, it says, assume the board of directors declares dividends. All right, so some dividends is declared, meaning that they need to get them paid. And the total that they declared is $1.5 million. I hope you guys can see this well. So the total dividend declared, let me also just kind of, you know, hello, good day to you, Miss Janet. Nice to be here. So this is the declaration, right, of $1.5 million. Good. Now, it also says that the preferred shares are cumulative, right, which means that they have dividend in arrears. You know, if it's a case where we don't pay them in 1 year, right, you know, we still have to pay them, right? If we don't pay them this year and we move on to next year, that's going to be known as a dividend in arrears, meaning that we owe them some dividends. So when you owe them some dividend, when you don't pay them, it is called a dividend in arrears, means I owe them. Now, it says that the preferred shares are cumulative and no dividends, this is very crucial, no dividends were declared after 2022. So right now we are in operation year 2024, right? We're in 2024 year of operations, right? Which means that there wasn't any dividend declared after 2022, which means that we owe them for 2023, and we also owe them for the current year, which is 2024. So we are currently in 2024. That's what we are currently as a current year, right? And we never paid them any dividend in 2023, which means that no, we owe them. So how much years do we owe them for? All right, so we owe dividend. We owe dividend for, all right, for 2023 and 2024. That's 2 years. All right. So we owe them for 2 years in dividends. Cool. All right. Now it goes on to say that we need to calculate the amount per share each class of shares will receive. All right. Don't get confused, guys. Do not get confused. Do not get confused. Do not get confused. We are going to do this. It's easy. Really easy. Really easy work. All right. So all we're saying now, right, is that what they want us to do, the question, let me put the question right here. The question, what they want us to do is to calculate, we need to calculate the amount. I'm just going to short amount as AMT. We need to calculate the amount per share, and when you have a slash, that means per share. Per share, each class of shares will receive. All right, when they say class, they mean preferred and common shares. 2 classes of shareholders, preferred, common shareholders, right? Cool? All right. Now, they also need to run it to the 2 decimal place. That's something that everyone should know. Like when you're doing these things, they don't run into the 2 decimal place no matter what, unless stated otherwise. All right. Now let's get into it, guys. Now, remember, I must say preferred shareholders have privilege over common shareholders, right? Remember, I told you guys that preferred shareholders, they have privileges over common shareholders. Remember, telling us that preferred shareholders has to be paid first. They have to be paid first. We have to prioritize our preferred shareholders over our common shares. All right, so let me show you guys now how we need to divide up the declaration amount, because as I said, we declared $1.5 million, right? And out of this $1.5 million, we need to pay our preferred shareholders first. All right. Now, we say that we owe them for not only 2024, but we also owe our preferred shareholders for the year 2023, right? So we owe them for 2023, and we also owe them for 2024. 2 years owe them for. Cool. We owe them for 2 years, and we also say that, all right, 2 years we owe them for, that's a dividend in arrears. Now, based on the information given, if you guys are looking right here, based on information given, it says to us that preferred shares are valued at $4, right? That's the value for the preferred shares, $4. $4, if you guys can see what's going on. $4. Can you guys, you guys not gonna see, but yes, the preferred shares are valued at $4. So now, all right, 2 years in arrears, right? We know that the preferred share is valued at $4, and we also know, right, that we have, based on information given, 100 shares issued and outstanding, right? So we issue some shares, right? And it's also outstanding. No need to pay these guys. We need to pay these guys, right? And have it not being outstanding. So I'll do that now. We'll say, all right, 2 years outstanding in arrears, right? $4 per share. And we also have 100,000 shares which are outstanding. It's 100,000 shares that are outstanding. So let me just put a little note in the chat. Let me put a little note for those guys who might not, see what's going on. So we'll say we have 2 years old, 2023 and 2024. Whereas we have the preferred shares being valued at $4 each, with 100,000 shares issued and outstanding. Therefore, to find the amount to be given to P shares, P mean preferred shares, just because I don't have enough holders. we. So what we're gonna do is I'm gonna say 2 years that was owed, right? Times that by the 4, which is the 4 is the value of the preferred shareholders. And we'll say that those 4 we issued 100,000 of those share at $4, which means that hey, 800,000 will be going to the preferred shareholders. So you guys see where I'm coming from now? You guys see where I'm coming from? That means that hey, 800,000 will be going to preferred shareholders. You guys see what I'm saying? The preferred shareholders get the 800,000 right here. I'll send it in the chat. Now, common sense will tell that okay, now that we clear off our preferred share balance, right? Now that we have cleared off our preferred share balance, we need to go back and clear off the common shares. I mean that, even though we have to pay our preferred shareholders first, above our common shareholders, once we finish paying off our preferred shares, we can go back to pay our common shareholders, right? So now that we know that, 800,000 will be paid, right, out of this 1.5 to preferred shareholders, then that means that the rest of it is going to go to our common shareholders. So we're going to need to pay off our common shareholders. So, all we have to say is that the common shares will get the rest. Right, they get the rest of whatever remains. So it's gonna be 1.5 million that was declared, less the 800,000 that we already had issued out to our preferred shareholders, which now means that 1.5 minus 800,000, 1.5 minus 800,000 is 700,000, correct? Right, 700,000, and this is what our common shareholders will be receiving. Now you guys get what I'm saying? Or if you guys get what I'm saying? You guys get it? Got it? You guys got it? Still with me? Let me see if you guys are with me. You guys with me? Hold on guys, hold on. I need to ask you guys. With me everyone? You guys see how alright, thanks for that Miss Cohen. Yes man, very soon. The company is gonna establish very soon, man. I'm working on it. We're working on the company coming out soon. So you guys get what's going on here, right? You guys got me. If you guys get me, just say it in the comments below, please. If you guys need me to explain the next concept, I'm willing to explain any concept needed. Alright, so we can just do it right way, guys. I understand. Very, very intuitive. Very, very intuitive. All it said here. Got it. Alright, so I see Miss Campbell, Miss Carlene Campbell got it, Miss Winifred got it, Miss Gemini Twin, just coming. I guess Miss Mildred as well is just coming on the live. Anyone else just coming? If you need me to tell you guys what's going on, let me know. I'm willing. I have lots of water here. I have one heap of water here. So Let me know, man. Let me know. Because we don't finish it, We don't finish yet. We don't finish at all. Right? Let me know. Everybody good. I guess it seems everyone is good. Alright. Now, stick a pin. Alright. So we know, and let me put something in comment. Out of the 1.5 million declared by the board of directors, the board of directors. This is what we know, right? 800K, which is 1,000, will go to our preferred shareholders, whereas the other remaining amount, 700K, will go to our common shareholders. Now, that's all we just did, right? That's pretty much all we just did. So don't, that's all we just did and calculate. Don't worry, if it just come, that's all we did. Now, let's just keep that one side. We want to keep that one side, right? So we want to keep that one side. We're gonna rub. We want to keep that one side because, we are going to rub. So we'll say that 800,000 is going to our P shareholders. P shareholders just mean preferred. We just chart it as P, you understand? And we also say that 700,000 will be going to our common shareholders. Cool? Alright, look at me now, guys. Look at me now. Now, it says that we need to calculate the amount per share each class of shares will receive. Alright. So now we need to calculate the amount per share each class of shares were to receive. Now, to calculate the amount per share, guys, amount per share. All we need to do in this case, guys, you guys understand what I'm saying, guys? All we need to do is just say 800,000 is going to go to our shareholders. You understand? 800,000 is going to go to our preferred shareholders. Now, we need to calculate the amount per share that's going to go to each shareholder. So you know how much we do this now? Alright, look, we said earlier that we issued 100,000 shares in preferred shares, right? This is the total amount of preferred shares that were issued. That's 100,000, right? Now, if we know that 100,000 shares are issued to our preferred shareholders, and we also know that $800,000 will be paid out to these shareholders, all we have to do, guys, is just go like this. Bams, cancel the zeros, and the amount paid out, $8. Amount paid out, $8. Look what I'm saying now, guys. Look what I'm saying. 800K to P shareholders, right? To P shareholders, and 100K shares issued, right? 800 divided by 100 equal is a dollar sign, $8 per share. See? And that's it for the preferred share amount. Hello, good night. Good night to everyone that's just joining. Alright, so now that we'll find for the preferred share, we can also find for the common shares. Amount per share for the common share. The same way, we know that we're going to get 700,000. How much that was issued? 190,000. Let me get my calculator. 700 divided by 190. The same thing, the same concept, right? We're going to get 3 equal, I don't know if you guys can see what's going on there, 3.68. So the common shareholders, they're going to get 3.68. When you guys see what I'm saying, the common shareholder is much less than the preferred share. The preferred share, they're going to get even more because they have more rights and privileges, and the preferred shares tends to be more expensive. No, that's what I'm saying now. I'm saying is that 800K, right, to C shareholders divide by, let me see, 190,000, 190K equal to, how much is that? 3.68. Alright. Miss Louis says she will never go into shareholders. I don't believe in it. Well, yeah, I mean, certain people prefer like partnerships, partners between two people, or however they want it. And some persons also prefer in a sole trader business. You own your own business, single trade. But I mean, shareholders is good in terms of, let me see. It's easy to start up. You don't have to bear any losses. Your losses is only limited to what you invested into the business. So it's like you're gonna, if your business to be liquidate, you won't lose much. Just what you invested. All right. Now, that's it for A. So complete question A, we can get amount per share. Now, we're going to do something in accounting, right? That is called, good day to you, Miss Yolanda. Nice to have you here watching. We're going to do something in accounting which is called a stock split. All right, pretty easy. Stock split is where you basically issue dividends based on the number of share ownership in the business. Ownership in the corporation. Right? I know you guys can't see nothing on me right here, so I know. Right? So say, when it comes on to stock split, right? What is a stock split? We're going to discuss this one, do a question. What is a stock split? No, when we say what is a stock split, all we're saying is that, A stock split refers to the number of dividends being paid out based upon the number of share ownership a shareholder controls. All right. And in layman terms, when we talk about stock split, all we are saying is that, hey, bossy, if me own this amount in the business, as me say, me need to get a high dividend pay. As me say, because me own this amount, me need to get a high dividend pay. The difference between the stock split and the stock dividend now is that the stock dividend affects retained earnings. It's gonna reduce the stock dividend, which you just did. It will reduce our retained earnings and it will increase our share capital. With stock split, it doesn't have any effect at all on those accounts. Right? It doesn't reduce retained earnings and it does not have any sort of effect on our share capital. It has no effect on the accounts. Cool. So we finished that right there. That's the basic concept. All right. Now, question B. Time for another question, guys. Time for another question. Hooray. All right. So if you don't catch question A, let us see if we can catch question B. Let us see if one person can actually catch question B. All right. Now, good day to you, Miss Evans. Good day. Now, question B says, assume the board of directors authorize. All right. So the board is those who act on behalf of the shareholders. They're like a governor general. You understand? So now it says we need to assume that the board of directors authorize a 2-for-1 split. All right, 2-to-1 split. Cool. Now on common shares, Zine. So this is authorized on common shares. All right, cool. It says that calculate the number of shares outstanding after the split and the average per share amount for both classes of shares. Round to 2 decimal places. All right, cool. No problem, man. No problem. They give you this. We're gonna deal with it just as how they want. So, guys, them say a 2-for-1 split. Cool. No, they say we need to look on common shares. Remember, I told you guys earlier. Common shares. We're looking at common shares right here. Common shares issued is 190,000. All right. Cool. We issued 190,000 common shares. Now, with the split coming into place, the split is a 2-for-1, right? So it's just like saying, all right, times 2. I mean, if you also say times 1, it's going to be irrelevant, right? Because it's the same thing you're going to end up with. So let's say times 2 for simplicity. 100,000 shares that we had issued times 2, which means that after the stock split, we're going to have 380 shares, common shares issued. You guys get what I'm saying right here? You guys get what I'm saying right here? 1, 2, guys. You understand? Remember, I know it says, assume the board of directors authorize a 2-for-1 split on common shares. Calculate the total number of shares outstanding after the split. This is amount of shares outstanding after the split. How did we know this? We said to ourselves that, okay, 190 shares were issued, right, and outstanding, but after the split, which is 2-to-1, 190 times 2 equals 380,000 being outstanding. You understand me? All right. Now it also says that we need to calculate the average per share amount for both classes of share, round to 2 decimal places. How do we do this now? All right. So it's when it comes down to the common shares. We know that the common shares, if you look on the question, you guys, as I said, guys, you need to look at the question if you want to see this. The common shares were valued, the 190 that was issued was valued at $2.425 million. Let me write that good. So 2,425,000, the common shares were valued, right? Now, we also knew that after the stock split, we had 380,000 shares being issued at this amount. Same way, because that's what it was valued at, right? Now, that means now we can now find the average per share amount. The average per share amount would be equal to You guys catching me up? You guys catching what I'm saying? Average per share amount will be equal to 2,425,000, right? Divide by 380,000, which will give us a total of 6.38. All right? Now, let me just reinforce what I just did. Now, we need to calculate the average per share amount, right? To do so, we find the value of shares that were issued, which in this case is 2,425,000, and then go on to divide that by the total common shares after the 2-to-1 split, which is 380,000, which equal to average per share amount of, how much is that? Amount of 6.3 of 6.38. All right, so you guys see what I'm saying, right? We need to calculate the average per share amount, and that's the explanation. That's the basic explanation, all right? Now, cool. We did that, right? Now, so just calculate the common shares amount. Just calculate because them also want us to calculate the average per share for both classes of shares, right? So the calculate average per amount for the preferred shares. We just did the common shares right here, right? Now let's calculate the one for the preferred shares. All right? You guys watch me now. So we say preferred shares. In this case, preferred shares 100,000 issued at $1.3 million. All right, $1.3 million. All right, over the 100,000 that we issued equal 1.3. That $13. As simple as that, guys. Nothing to hurt the brain, right? Nothing to hurt the brain, right? Same way to find the preferred shares. I might spell a few words incorrect, so watch that. Preferred shares. Same way to find the preferred shares. All we do, take the value of shares issued, which in this case, is what? $1.3 million. $1.3 million, and divide that by the number of shares issued, which is 100,000, hence equal $13 average share amount. And that's it. And that's we, guys. Good evening to you, Miss Hermin. Nice to have you here, Miss Hermin. You guys see, so we just done 2 questions. Congratulations. Let me say it in the chat. Congratulations. Tulations. We finished 2 questions. There we go. Well done, guys. Well done. All right. Now, who is ready for the 3rd question? All right. You guys ready now? All right. I know you guys ready. All right. You guys ready now? Good night, Miss Janet Newbold. Nice to have you here. If you want to catch up with us, definitely watch the video from the start. Nice to have you guys here, man. All right, guys. Let's go. Question number C. Well, question number C. That's so funny. Letter C. Assume the board of directors authorize a 10% stock dividend on the common shares after stock split. Alright? Big words. Guys, I'm going to use big words to scare you now. So what you must know. Let me say they authorize a 10% stock dividend, right? Stock dividend on common shares, right? After, that's a very key word, after the stock split. So guys, look what we're saying now. Guys, remember, before the stock split was 190,000 shares issued before the stock split. Now, this question wants us to do the 10% after the stock split. After the stock split, it was 380,000. So this figure is very imperative to write down. 380,000 after the stock split, right? Now, it also say that we need to prepare journal entries to record this. Alright? So after the stock split, right, we had 380,000 and also the current price, and this is very important, right? This is very important. Whenever you're in accounting, always use the fair value of an asset, always use the fair value, the market value. So at this time in the market, the share was going for $11. All right, let's do the maths. 380,000 times that by 11, right? We get 4,180,000. All right. Now, that is the value of the stocks on the market. It's so much the value of the market. $4.1 billion. Let me catch you guys up before I go too fast. Now, guys, they are trying to trick us, right? They are really trying to trick us, But we got this. All right. So let me just take up a marker. So here's what's happening. So here is what. So here's what's happening. Alright, so here's what's happening, guys. Because they're trying to trick us right now. Oh, I need to fix up my grammar right here. Oh wow, why is that my pressing the wrong? Okay, there we go. So here's what's happening now, guys, right? They want us, let me see what the question asks again. They want us to they want us to show them the authorization of 10% on common shares after, very important, let me put it in, after stock split. All right, now after stock split, there is 380,000 shares issued. 380,000 shares issued, right? After the stock split. 380,000 issues valued at $11 at current market price, aka fair value. Now, all we're saying here is that, hey, look at this now, guys. Simple maths, right? 380,000 valued at $11. That would give us a total of what? 4.18 million, 4,180,000, right? That's what the current value. No, they want us to find. No, guys, they want us to find 10%, right, of the shares. Hence, 418 on the market times that by 10%, we're going to get a total of, all right, let me see what's going on. What should I get? 480, all right, 418,000, all right? Bumps. You guys see what's going on? Hold on. You guys see what's going on here? No, all I'm saying is that what's happening here is that they want us to find out, how much after the stock split is 10% of the stock dividend. Alright? And that's the explanation in the chat below. So let's move on. Now, After finding out that, after doing the maths, they want us to journalize that transaction, all right? They need for us to journalize that transaction. So how do we do that now? All right. Now, they want us to record the transaction when it was declared, right? 1 second. They want us to record the transaction when it was declared and also when it was distributed. Look what I'm saying now, guys. Now, upon declaration of the transaction, this is how the accounts will be affected. Now, there's going to be a debit. I know a long time when they talk about debit. You understand? Yeah, man. When they get so far in accounts, come on, debit and credit are one of the things that we have to hear about again. But yeah, man, we're going to debit stock dividends, right? We're going to debit stock dividends, right? Because we're reducing this account. When you debit the stock dividends, you reduce it. Right, now, we're going to also credit to stock dividends distributable. All right. Increase the account with the credit right there. Of how much? How much do we calculate, guys? 418,000. 418,000, all right? Now, when we need to pay out, so we're going to pay it now, right? We're now distribute it. Upon distribution, let me put some nice dollar sign here. Upon distribution, what happens here is just to do the reverse. There's going to be a debit to stock dividends distributable. The same 418,000 and a credit to stock dividends because we're paying out the stock dividends. You understand what I'm saying, guys? Same 418,000. So two journal entries, one to declare. Let me see something. Alright, so that's good. Let me see if you guys are with me. Let me see if you guys are with me. So we did the declaration, 418,000, right? Based on what we just calculate up there, right? And we also did the distribution, right? Now, it said to us now that, let me see, what else? Oh, I think that's actually the end of it. Yeah. That's actually the end of it. Alright. Now, guys, that's the end of question 1. I think that's the end of question 1. You see, guys? End of question 1. That was very good. Very, very good. End of question 1. So let's chat for a minute. Let's chat for a quick minute, guys. I hope I'm not interrupting the audio. Let's talk for a quick minute and then we can go on to question 2. Then this is going to be the last question that we have to do today. And yeah, but let's talk for a minute. What are you guys doing? Let's have 2 questions. It's only 2 questions for today. Only 2 questions. And in this question, we're going to only work part A and part B because of, interest of time. So I don't want to, cover you guys with too much matter, too much information at once. All right. So yeah. But yes, guys. Let me have some water. Exactly. That's very good. Actually, what's your unstoppable? That's very good because I think workers, right? They get some certain extra credit for their shares that they hold in the company, and I think at year end, you guys are good. Once you buy stock through your company, that's the best thing you could do. The only thing is that if the company bear a loss, then you also bear a loss to your stock as well. But if they make a profit, then everyone is good, right? So yeah. And also if like the share prices increases over time, then also you don't have to pay for it again because you can also get that in the package. So that's good. It's really, really good. Okay, so lots of persons buy stocks. Okay, that's great. That's good. That's really amazing. That's really good. That's really, really good, guys. It's great to buy stock and also have knowledge and how to work the market because you might never know what's gonna happen, right? You might never know what's gonna happen. So it's good to have knowledge on these things. But yes, guys, so we just did quite a few questions. Oh, sweet. That's great, Miss Campbell. That's really good. Sorry. Yes, guys. So you guys just learned a few things, which is very good. You know, you guys learned quite a few things. You know, and yeah. In the meanwhile, maybe I could show you guys my winter boot. You know, let's take like 15 minutes, and I'm gonna show you guys my winter boot. I have it just right around the corner. You know, it was. Hold on. Okay. Here they are. I wore them like twice now. Here they are. And alright, let's go get over here for a minute. I'm not sure you guys done. Big up to Miss Cohen, if Miss Cohen is still here. Big up to Miss Cohen. So here they are. Maybe I should try them on over on this side. I have on no socks, you know. But it's pretty good. It's pretty nice. Yes, Miss Grant, a little bit late, but no worries. You know, I can catch you back. We have a second question to do. We just finished question 1 and we're gonna go into question 2 very soon. So no worries, no worries, no worries. Alright guys, so this is the winter boot that I have right here. And it fits well. It fits really well. You know, it fits really well. It's a 9. And it's like really nice inside as well. As you guys can see, it's pretty nice inside, cushy as well, and warm. It feels so good inside, you know. It feels really amazing inside. Let me show you guys. It's like furry, like a furry dog, you know. It's really amazing inside. Yes, Miss Cohen, they fit really, really well. They fit really nice. Yeah, so that's good. I'm ready for the winter now. Ready to take on the climate, ready to take on the cold. And yeah. Alright, so I'm seeing we have some person that knows about stock in the comments. That's great, guys. We'll keep it up. Hopefully one day I buy stocks through my company. Well, at least if they're profitable. I mean, yeah, they should be profitable. So one day I'll buy my stocks as well, and then, yeah, let us see how it works. So yes, guys, I'm going to start back on the next question in about 2 minutes, right? You know, yes, man. Y'all say big up to Miss Cohen, definitely. What's here to eat? I'm gonna have some corned beef for them finish, and then I need to get off and I'm gonna finish practice question 3. Then I'm gonna finish question 1 and 2. Off the next one by myself, and yeah, I should be able to get through a lot today. So, guys, ready again? All right, boom bam. That's what my teacher loves to say in Jamaica. Boom bam. You might have 5, but it's better than nothing. Yeah, of course, 5% is better than nothing, right? At least you're getting a return back on the investment. And I mean, just hope that the company doesn't go bankrupt, because if it goes bankrupt, then you're gonna lose your investment. But it should be good. No worries. That's a good investment. Stocks is always a good investment, and it's not so expensive. So that's good. All right, guys. All right, I'm gonna have some little bit more water, because this one is gonna require some listening, right? So guys, if you're just coming on the live, welcome back. You know, we are going to start question number 2. We have 2 parts to this question which we're gonna work. You know, 2 very simple questions which I'm gonna try to keep as short and spicy as possible. And yeah, I think I'm gonna get you guys on board. I'll also post the solutions, because there are solutions, but it doesn't make sense looking at the solutions and don't understand the logic, because accounting tends to change things up in many different ways, and if you don't understand the logic, then you don't know what you're gonna be doing. You know, so it's great to understand, like, you know, basic logic, like what we just did, to understand how to calculate the average per amount of shares, right? Or to understand how to do the stock split of shares. You know, things like that. You know, things like that's great to know. You know, because they can switch up questions different way. You know. Yeah, and that's a very good point, Miss Cohen. Ensure that you invest your money. If you're going to invest in a company that, you know, ask them for their financial statements. You know, that's one right you have to do. You can ask the company for their financial statements, see how they have been doing over the years. You know, look at how much profit they have been making over the years. You know, look at their expenses over the years. You know, look at things like that, and ensure that you're, you know, pretty good. And look at the fact that, you know, if they should become, you know, bankrupt can't operate anymore? Do they have enough reserve to pay out to whoever shares they have in the business? So that's a good thing to look into. So you want to know those things before you invest in money into a company, especially if you're going to invest lots of money, like a large lump sum. Look on your financial statements. Never heard of that one yet, Miss Campbell. Never heard of that one. Well, yes, guys. Now, are you guys ready? Are you guys ready? Let us go. Let us go, guys. It's another month. Feeling great. Hello, Miss Allison. Welcome to the live. We're going to start our second question today on corporations. Let us go. Thank you so much for 200 likes. Thank you. Thanks for 200. Actually, 200 likes. This is so great. Thanks a lot, guys. Let us go, guys. Let us go. So this question states right here that, and it's guys, if you're just joining, you don't know where these questions are, go to my community post. All of these questions are at my community post. It's there. And currently we are doing question number 2. All right? So go to my community post, maybe take a screenshot or something, or just go to my community post and scan through the question, scan through it. I'm going to post the solutions afterwards in my community post, all right? Now, let's all right, the train moving off now. All right, so this question states, Strict Fitness Limited has a December 31st year end. On January 1st, 2024, the company had the following shareholders' equity accounts. So, all right, Strict Fitness Limited had preferred shares valued at $5 cumulative, meaning that you can owe them in arrears, right? You can owe the shares. And also, there was a unlimited number authorized. That irrelevant, don't pay any mind. What you want to take out from this question is the fact that, hey, we have some preferred shares, they are cumulative, they value $5, and we issued 5,500 of those shares. All right, just note that down. The first thing you guys want to do, note that down. Now, move on. We have common shares, 160,000 issued. All right, cool, good. We also have retained earnings, $2.2 million and 15,000, right? So that's good. We have some profit in the business. We have some profit. That's our retained earnings. And we also have a cumulative other comprehensive income. Cool, all right? Other type of income, other incomes, all right, no problem. Now, the first one states here, record all of the transactions, all right? So these are the transactions that they want us to record. So these ones you guys see here in the question, they want us to record this. All right, no problem. Let us record right here. They need us to record this. So the first transaction that took place was on January 31st. All right, cool. So what happened, guys? What happened on January 31st? All right, so you're going now. So what happened here is that we issued, right? And when you say issued, we mean that you sell off some shares, right? So we issued, you guys can see what I'm saying? We issued 40,000 common shares at $8.5, 8.5 cents per share. Thank you so much for the super chat, Miss Jeanette Johnson. Thank you so much. And I'm hoping that, your $10 is worth the knowledge that you're receiving here. Thanks a lot. Thanks a lot. So, on January 31st, we're going to see what took place. We issued 40,000 common shares, all right? So, guys, we issued 40,000 common shares, all right? And we issued that at $8.5 per share. Basic maths. Always say, okay, we issued $40,000 at $8.5, 40,000, 8.5, 340,000 in total. So we'll say, all right, we issued that, meaning that we are getting some cash, we're getting some money into the business, money coming into the business. And when money coming into the business, guys, Money is an asset account. Asset, you own it, right? And you earn money. You understand? So when you want to increase an asset account in the principles of accounting, when you want to increase the asset account, you debit it. So now we're going to have a debit to cash. You understand? And we are bringing out some common shares, right? But common shares is a capital account. It's a share capital account, right? So we are increasing our common shares. But you see, look what I'm saying, guys. Cash, which is an asset account, right, increases with a debit. Now, it's when it comes on to common shares account, which common shares is a capital account, right? We are also increasing. We are increasing the number of shares that we are issuing. We are increasing the number of shares that we are issuing, which means that, all right, watch me now. I want you to be 340,000. All right, we got some cash, 340,000. We increase our common shares that were issued, 340,000. All right? My bad. Let me take a long look here. No, that's for January 31st. You guys see what's going on? Let me make sure you guys see what's going on, because I want you guys to see what's going on, you know. This isn't a joke thing. We're talking about money. So you guys see what's going on right here? This is what I say we do now. All I said that we do, we debit our asset account to increase it, right? We also increase our capital account with a credit balance, right? Don't get them mixed up, guys. Asset account, capital account, two different accounts, two different principles. Asset account, for example, the cash account increases with a debit and decreases with a credit. Capital account, example, the common shares decrease with a debit and increase with a credit. They have an, as we would say, inverse relationship. You understand me, guys? Cool? They have an inverse relationship. Guys, that's why we have debit to cash, credit to common shares. All right. Let me reduce how much that I have on the screen right here. Let me just not to confuse anything. So let me just put the transaction as simple as possible. You understand me? So there we go. All I'm saying, debit cash increase is 340, credit common shares 340. All right. Moving on to the next transaction. This transaction occurred on February 28. It says here that we issued 1,000 preferred shares at $110. All right, same thing. The only thing different is that we're going to credit preferred shares because we issued preferred shares, right? We just credit preferred shares, and that's also a capital account. You understand? For 100 times 110, that sounds like 110,000. I mean 1,000 times 110, that's 110,000. Here we go. All right. So we're getting into meat of the matter now. March 31st transaction, guys. I said this is a transaction, yeah? This is a transaction that nearly twist my head. You know when you actually learn a little thing, you say, oh, where you get them player from? Yeah, man. So them say we reacquired. All right, guys. You see when we reacquired some share, we basically buy them back. We are buying back our share, right? We are purchasing back our share. So if we go purchase back our share, guys, what that mean? We're gonna purchase with some cash. We're gonna purchase with some cash, right? We're gonna purchase back some shares. All right, sure. We're gonna purchase with some cash. So if we're gonna purchase with some cash, so we acquired 20,000 common shares at $10 a share. 200,000. We're gonna purchase back them shares here in cash. So all we need to know, credit to our cash account, 200,000. But here is the tricky part. Guys, nothing guessing on me yet? Hold on, I'm still the guy. I'm bringing it a bit more. Guys, we're there right here, so you guys see what's going on. Guys, nothing gonna settle me yet. Must say that part of the question in the twist me head. So I'm telling you guys, pay good attention now. Now, guys, now, if we reacquired 20,000 common shares, you see, what me that think we do now is to just put a debit to common shares 20,000, but no, and that's how it go, right? Because we now go the value of the common shares and what we are get back in our business in now go value as the same amount what we are paid for it in cash, right? It's going to decrease what we call our retained earnings or profit. Going to decrease. You understand what I'm saying? Our profit is going to decrease our retained earnings, and then we're going to also have to decrease how much common shares we had issued, right? So remember, the capital account has gone down in our window because we are decreasing it. How much common shares we had issued, we are decreasing it because we are buying it back into our business. Guys, let me put a note. Let me put a note in the chat. Because with this calculation, what that we're going to do, the calculation that we're going to do is going to be very imperative to understand what's going on right here. So now, we bought back some of the shares, right? So we bought back some of the shares at $10 for 20,000 shares, which means that we paid 200,000. We paid 200,000 in cash, and as such, we credit our cash account. Cool? Now, what to debit? Now, what to debit, you ask? Remember, now we will debit our retained earnings account as well as our common shares account. But the real question is, by how much? How much? That's the real question of today, guys. That's the question right now. That's the question right now. Let me get my marker. Sorry. That's the question right now. This nearly take with all my brain cells. So look what we do now. So it's said to us now, guys, how much we ever debit our common shares account for, how much we are going to debit our retained earnings for. Alright guys, money for showing this. Guys, what I'm telling you guys, I need to show you this somewhere clear. Let's tell me when we can. Alright, wait, hold on. I'm just gonna drag this up more because I need to show you this somewhere we're not gonna see what's going on. Guys, look at me now. Now it says to us that, right? We are dealing with common shares right here. Guys, we're dealing with common shares. Well, you need to understand this one now. So we'll say that, alright. The common shares that we issued, right, were valued at 1.2 mil. Alright? So the common shares that we issued, that's what we need to know. Issued, right, were valued at 1.2 mil. Right? And the total common shares were 160,000. Guys, I preach right now. Guys, look at what I'm saying, guys. You see the common shares that we issued, right? We issued 160,000 shares. We issued 160,000 shares, which is valued at $1.2 million, as you can see here. Now, we also went on to issue some more shares, right? We issued as well 4,000 extra shares, right? Which this 40,000 extra shares was valued at, alright, so all we have to now say 40,000 times about 8.5, we calculate that right here the first time, which is valued at 340,000. Cool? Alright. Now, you know what we need to do now, guys? We need to just go ahead and divide these out. Just like that. And then we can find out how much the average per month, right? We can find the average per month after we divide this out. And then after finding the average per month, you understand, we can then say, okay, the average per month times how much we reacquired will give us our balance in our common shares account as well as our retained earnings account. So let's do the maths. All right, so 1,220,000 plus 340,000, 1.56 million, 1,560,000. All right, and then 160 plus 400,000, 200,000. I mean 40,000. Right? So you guys see what we just do right there, guys? All I said is that okay, right? At $1.2 million, right? Value of the shares that we issued, we issued 160,000 valued at 1.2 mil. We also then went again to issue 40,000, which was valued at 340,000. Add up the values then, add up amount that was issued. All right, when we say now 1.56 million divided by 200,000, amount per share equals $7.8. All right, let me type in the chat what exactly I just did. See what I said? So, now, to answer that question, right? We issued 160,000 shares at valued at 1,220,000, as well as we went on to issue another 40,000 shares. 40,000 shares valued at how much? 340,000. All right. When we add the values of the shares, which is basically 1.22000 plus 40,000 plus 340,000, all right. We get 1.56000. Now it's time to add the number of shares issued and divide that by the value of the shares that we just calculated at 1,560,000. The number of shares issued are 60,000 plus 40,000. It was this signal, it's actually 160,000 right now. So 160,000 plus 40,000, cool? Which then is equal to 200,000. And as such, we can do the math. Therefore, 1,560 divided by 200,000 will give us an average amount on the shares reacquired of what's the amount? 7.8, which leads us into computing the 20,000 shares that we reacquired and multiply the 7.8 average amount per the share. Therefore, common shares value would be equal to I get 20,000 times by 7.8. What is that? 156,000. And the difference between what we paid and the common shares amount will go to retained earnings. Therefore, let me see. 200,000 cash that we paid less the 156,000 that goes to the common shares would give us a total of 44,000, which would be debited to our retained earnings account. And that's it. Wow! 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 Guys, you see what I'm saying, guys? Very great explanation in the comments. Very good explanation in the comments, guys. Wow. Guys, we are preach. So we now know that. One second. One second for me, guys. Let me see something that I just did. Okay, hold on. Let me find back on Chrome. Open. Miller. YouTube. Let's see. Okay. Xdog Live. And there we go. Alright, guys. So. Alright, guys. Great. Let me pin this message. Replacement message. Alright, here we go. Alright, so we're moving. We are moving, guys. We are moving. You understand? We are moving. We're almost there. We're almost at the glory land. Alright. So that's how we figure out how much will be going to retained earnings. Right? I did a big explanation on that. And we can say that to common shares, we would have 156,000 going to common shares and 44,000 going to retained earnings. If you look, our debit equal our credit of 200,000. Understood? Alright, cool. Yes, man, guys. There we go. Thumbs up if you understand the comments. Thumbs up if you understand. Let us get back on track. Now, moving on to June 1st. June 1st said that, hey, we declared a 10% stock dividend, alright? So we're declaring more dividend again on the common shares outstanding. Now, how much common shares do we have outstanding on June 1st? Okay? To be distributed on June 30 to the shareholders of record on June 1st, alright? No problem. Now, all the more we to do, guys, is to just, pay out the common shares. They need us to pay the common shareholders, okay? No issue. How do we pay them? Alright. Now, it says to us that, okay, the fair will have common, okay, sure. So, they declared 10% of common shares outstanding on June 1st. How much common shares were outstanding, alright? We had 160,000, right, as well as we got 40,000 back, and we also reacquired, guys, look what I'm saying. So, they need us to find out 10% of stock dividend on common shares issued, basically. Right? That's what they need us to do. Find 10%, right, on common shares issued. So how we do this now? How do we do this? Alright, let me just quickly rub right here. So let's look at how we do this now. All we do is that we say, okay, we had 160,000 common shares issued in the first place, right? On January 31st, we went back, issued 40,000 more. But on March 31st, we went back and we acquired 20,000 of those shares. So we bought back those shares. So 160,000, right? Plus 40,000, 200,000. Less 20,000 that we reacquired, which means we have 180,000 shares outstanding, and we are going to pay dividend on 10% of these shares. On 10%, on the 100,000 and 10%, guys. How much? 18,000? Yeah, 18,000, right? I'm just trying to be sure. So we have 18,000 right there, and they said the current market value of this share is $12 per share. All right, no problem. Let's see how much you're gonna have to pay them. 18,000 times that by 12. 216,000. Very, very simple logic. Very, very simple logic. Very, very simple logic right here. You got what I'm saying, guys? Very, very simple logic. So, we go now and we say, let me see. We go now, guys, and all we say here is we're going to pay it off, right? Debit, stock, dividends, distributable, right? And then we're going to also credit common shares because we are increasing our common shares in this case because we are paying it off, right? For how much? The money that we just calculated, 216,000. 216,000. August 31st transactions tells us. Issued 25,000 common shares at $13 per share. All right, no problem. So we'll say 25,000 common shares times up by 13, and that's going to be debit to cash, credit, common shares. That's going to be 325,000 at 325,000, and that's that. So we just finish up the first part of this question, which is the generalized transaction, and we have one last section. We have one last section of this question. So this is the first part, right? Actually, let me see something. Let me just be sure to that I did everything that was asked of right here. Come on, stock, dividend, distributable. Great, 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 great. Sweet, sweet, sweet. All right, cool. So we're gonna need to use these journal entries because what they want us to do now, is that they need for us to go ahead to create the statement of changes in the shareholders' equity. All right. So let us use these journal entries that we just took, and finish our statement of owner's equity. So let me show you guys what's going on right now. So we're going to use these journal entries. I have them right here, so don't worry. Don't worry of me remembering them. I have them right here. I'm going to post them in the chat very, very soon. Right? Alright. Alright. Let us go. Let's go now. So, changes in statement of owner's equity. Alright, equity. Alright, cool, no problem. No problem. No problem. Now guys, you see once the journal entries them correct, everything is a breeze. You get what I'm saying now? In the shareholders equity, the question asks us to basically prepare the statement of changing in the shareholder equity. Let's do it. Let's do it, guys. We can do this. Now in the stakeholders equity, you calculate what is going to be our new share capital. Share capital, two types of share capital, preferred shares, common shares. Alright, we have preferred shares, right? And we also have our common shares. Cool? How much are these words right now? Get on the calculator real quick here. Bums, 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 number. Alright, my calculator. Common shares, we had an increase of 340,000. Coming down, we had a decrease of 156,000. Alright, coming down, let's see anything else. Alright, we got this decrease of retained earnings because that's the stock distributable. We had an increase in common shares right here, 216,000. Right, and then coming down, we had another increase of 325,000, which would give us a total of 725,000 in our common shares account, plus what we already started with, which is over around here of $1.22 million, 1.2 mil, which is 1,945,000. All right, and that's that for our common shares. Now looking into our preferred shares, just use the journal entries. Once you're right, then you're good. 110,000 here. Preferred shares. Any other affected? No. So preferred shares only here, only here, only here. Okay. How much did we start with? In preferred shares, we started with 550,000, which means that preferred shares will be valued at 660,000. All right. Now our total share capital plus 1945. 000 is 2,605,000. All right, and that's going to be our total share capital. and we just put SC as total share capital. All right, cool. Now, let's now go ahead to less or retained earnings. I mean, actually add or retained earnings. So you add retained earnings to your share capital, retained earnings, and let's figure out how much is our retained earnings. All right. So it says here that we do have a net income of 520,000, right? So we have a net income 520,000, right? We also, my bad. We also started with retained earnings of how much is that? $2.15 million, right? So we add those. We add this in the books, right? Right. So let me just see if we have any other income. Do we? Let me see. Do we? All right. So no. All right. Cool. So upon this time, we will have 2.5 plus 520,000. That's going to be 2735000. And now when we go back to less or retained earnings, because we did have some reduction in retained earnings, right? When we were doing that long calculation, we had some reduction. So let me go back to 44,000, and that's going to give us a total of, let me see, 2735 minus 44,000, and that's going to give us 2,691,000. All right, there we go. Now that's it for the retained earnings. We also have another account which we call accumulative other comprehensive income. All right, accumulative income, which here we had 52,000, so we can add that to there. And let me see, what else do we have here? All right, and we also have how much is that? Total share capital. We have this here as our total retained earnings. That's going to be our total earnings. And then our accumulated income, we have 52,000. And then to calculate the other figure, which is going to be our, let me see, we had, where is the other figure? Okay, here we go. Comprehensive income 592,000, right? And we need to less that from our retained earnings, which is going to be 592,000 less 520,000. That's going to give us a total of $72,000. Add that back to our share capital, and then capital at end. Capital at end is going to be, let's see now. So we have what we need to do. Do I have a different marker around here? No? Alright, so what we need to add up now is our total share capital of $2.6 million. Very important. Our total retained earnings to our share capital of 2.7, as well as our comprehensive incomes, 52,000, 72,000, and that's going to give us our changes in share in owner's equity at the end. All right, so let's go and calculate. 2605, all right, plus 2735, all right, equal 5, that, plus 52,000, plus 72,000. Give it a total of 5,464,000, and that will be our changes in the shareholders' capital at end. Let me see if I missed anything. Hope not. Wait, hold on. Minus 216. Minus 216. And yeah. I think that was the last question that we have to do today, guys. I think that's the last question. And that would be it at end. Oh my god, that was so much. But, we finish the statement. Let me make a note of something that I'm going to need to, probably go back through. Is that going to be on the less distributable stocks and from our earnings. All right, cool. No problem. All right, guys. Wow. Wasn't that a very, informative video? Hope you guys learned something. Even if it's just learning what is preferred shares. But I hope you guys learned something. And I'll see you guys on the weekend. Wish me luck on my exam, which is sometime next week, Friday. Yeah. So I think that's it for me today, guys. I'm gonna finish up with my studies. I have a few more things to complete today, and yeah. All right, guys. See you guys later. Bye bye. Uranus out.